This Chapter 1 examines the principal terms of a bond pursuant to its contract and teaches you how to calculate the exact size of the cash flows under the bond, particularly with regard to coupon payments, given the payment frequency and specific day count convention. The economic terms of any bond are more or less fully defined if we know its issuer, its face value, maturity date, coupon payment frequency, and day count convention. This term sheet for company ABC illustrates a typical bond. Thus, issuer company ABC, face value $100, maturity date in 10 years, coupon 8% per annum, presumably, coupon payment frequency quarterly, and finally, day count convention 30/360. Of course, there are other important terms you will want to know about this bond, such as its level of seniority in ABC's capital structure, such as whether it is secured or unsecured, and also what covenants and events of default in the bond's documentation are available to protect the bondholder. But while these affect the credit quality of the bond, they do not affect the size or timing of the cash flows the bondholder will receive under the bond in the ordinary course of business. Assuming that today is May 31, 2009, the term sheet tells you that you will receive $100 on May 31, 2019, in addition to an 8% annualized coupon rate. Coupons being paid quarterly means that you'll receive a coupon of 2% at the end of each quarter, calculated on the bond's face value, so that your coupon cash flows each quarter will be $2. It is common to depict the cash flows received by the bondholder under a bond by use of the diagram that has just appeared in front of you, where each arrow pointing upward represents a cash flow received by the bondholder, with all arrows being equal in size, except for the last arrows in aggregate, which include both the final coupon of $2 as well as the principal of $100. Furthermore, the equal horizontal distance between each cash flow reflects the quarterly payment feature, and the time between each coupon is normally referred to as the interest period, as you can see indicated here in the bright blue. Lastly, the one arrow at the beginning, which points in the opposite direction from the others, represents the purchase price for this bond. Over the 10-year life of this bond, you will receive 40 coupons, as indicated in the bubble in yellow at the bottom, with the last coupon being paid, as mentioned earlier, on the maturity date of the bond, i.e. at the same time as the principal. Note also the repayment in full of all principal at maturity, making this a bullet repayment as opposed to other financial instruments which may repay principal in defined installments over time. It is useful to calculate what is called the bond's effective annual yield, given the coupon and payment frequency. This is done by assuming that each coupon received within any 1 year can be reinvested for each quarter at a flat 2% until the end of that quarter, as indicated by these bright red arrows, earning the holder additional returns, as in this diagram. Note, however, that this assumption is just that, an assumption that may not be possible in reality, since interest rates may have risen or fallen by the time of any reinvestment. Nonetheless, the concept of effective annual yield is very helpful for purposes of comparing two bonds with different payment frequencies. A little algebra quickly reveals that by the end of 1 year, the aggregate amount received by the bondholder sums to this quantity here, revealing an effective annual yield of 8.24%. In short, the ability to reinvest, as indicated in the formula, the first coupon of $2 for 3 successive periods of 3 months each at a flat 2% rate, the second coupon of $2 for 2 successive periods of 3 months each, again at the flat 2%, and the third coupon of $2 for 1 period of 3 months, again at 2%, generates an additional 24 basis points of return for this bondholder versus a bond that pays its entire 8% coupon at the end of 1 year. Let's suppose we are comparing this bond to another one that pays an annualized coupon rate of 8.05%, but this time paid semi-annually. The equation above for the aggregate amount received by the end of 1 year now reads as follows. A much simpler equation this time, showing the first semi-annual coupon of 4.025 being reinvested at 4.025% for 1 6-month period, and no other reinvestments to deal with. And this, of course, reveals an effective annual yield of 8.21%, or about 3 basis points lower than for the first bond. Thus, despite the higher nominal coupon of 5 basis points apparently enjoyed by the second bondholder, the first bond ends up with the higher effective yield for the investor, given its higher payment frequency, which enables more return to be earned via the coupon reinvestment process. The Excel function effect, which we will soon illustrate via this worksheet effective yield, allows you to calculate a bond's effective yield if you know already its nominal coupon and its payment frequency. Thus, for bond 1, which we remind you has a nominal coupon of 8% and a quarterly payment frequency, the cell containing the effective yield was produced by inserting in that cell the function effect that you can see now appearing in front of you, EFF-ECT, and then inserting as the nominal coupon the item in cell C6, which is the 8%, and as the number of periods per year, Y per year, the item in D6, which of course is the frequency, and then hitting OK, revealing of course the 8.24% effective rate. And for bond 2, which we remind you had a nominal coupon of 8.05% and a semi-annual frequency, the same process involving the insertion of the nominal coupon from cell C7 and the semi-annual frequency from cell D7 reveals the 8.21% that we had found before. Excel also has a function called nominal that works in exactly the opposite direction. Knowing, for example, that the first bond has an effective yield of 8.24%, suppose you wish to calculate what should be the nominal coupon of a third bond that pays a monthly coupon for its effective yield to equal that of the first bond, i.e. to equal 8.24%. Continuing with this worksheet, we click now on cell C8 where we want the nominal coupon to appear and insert here the function nominal that has just appeared in front of you, and that asks us to specify the effective rate and the number of periods per year. Well, the effective rate that we want this bond to have is the 8.24 you now see in cell E8, and the number of periods per year is the 12 number 12 that you see appearing in cell D8, and then hitting OK confirms the number 7.95%, which should not surprise us because obviously the coupon frequency of this bond being substantially higher than that of bond 1 means that this bond can afford to have a nominal coupon lower than that of bond 1, since bond 3 affords the investor many more reinvestment opportunities than bond 1, and therefore can get away with the lower nominal coupon, specifically lower by 5 basis points. Turning next to the concept of day count convention, and remembering that the last coupon was paid on May 31, 2009, suppose it is now June 30, 2009, and that you wish to report in your financial statements, for example, the amount of interest that has accrued in relation to the first bond. It seems easy enough to say that with 1 month out of 3 having elapsed until the next coupon of $2 is paid, you have accrued 1/3 of this total, so $0.6667 to 4 decimal places of accuracy, and this would be the correct answer in this case, but only because the 3360 day count is being used. This day count in effect treats all months as if they contain 30 days, irrespective of the actual number of calendar days in each month, and treats the entire year as having exactly 360 days. So for each month that lapses, you accrue exactly 1/12 of the total annual coupon, hence the 0.6667. More precisely, you would calculate this as principal of $100 times the 8% annualized coupon rate times 30 over 360, even though a calendar year in reality has either 365 or 366 days in it. And if you were calculating the accrued interest 1 month later, i.e. as of July 31 of that year, this would come to 1.3333, again to 4 decimals of accuracy, based on the formula that just appeared in front of you, even though July is 1 day longer than June in reality. Unfortunately, there are some 20 or so day count conventions in total in the financial markets around the world, so we cannot possibly illustrate them all in this module. But a couple of them are particularly common and might surprise you a little in the way that they work. We turn first to the actual convention applicable in the U.S. government bond market, among others. You might know already that a U.S. government bond pays semi-annual coupons, so that one that has a nominal 8% coupon, for example, would pay exactly $4 per 100 on each coupon date. Assume now that the last coupon was paid on May 31, which means that the next coupon payment will occur on November 30. Assume also that on August 31 you wish to calculate the interest that has accrued so far in this period. Intuitively, the word actual in the first part of the day count convention would lead you correctly to calculate a total of 92 elapsed days since the most recent coupon, with 30 days in June, 31 in July, and 31, of course, in August, as you know. But the question now is, what should be the denominator in the calculation for accrued interest that appears in the red rectangle here? Clearly, if you go ahead and insert either 365 or 366 in the place of the question mark, you would be severely understating the amount of interest that has accrued, since the 4% in the formula has already adjusted for the semi-annual frequency of coupon payments. What you do, in fact, is insert in the denominator the number of actual days in this semi-annual interest period in which the calculation date falls. This being the period from May 31 to November 30, the actual number of days comes to 183 for the entire period, as you can confirm in your own time. So the correct calculation yields an interest accrual appearing in this red rectangle now and aggregating just over $2, consistent with your intuition, accurate to 4 decimal places. You should be able to see quickly that this convention gives rise to the peculiarity that while the two coupons paid semi-annually are equal to each other in dollar amounts, the amount in dollars at which interest accrues each day is different in each of the two semi-annual periods in any one year. The second important day count convention to address is the actual 360 convention appearing now, which applies to US dollar LIBOR calculations and to a number of other money market instruments. Assume the interest formula for a given investment is equal to 3-month LIBOR flat. That 3-month LIBOR resets on May 31 at 6%, and that you wish once again to calculate the interest that has accrued as of July 31, i.e. 61 days since the most recent coupon payment. This time, the calculation is a little easier, being 100 times 6% times the actual number of days divided by 360, giving 1.0167, as you can see here. The main point being the use of a denominator of 360 in all cases. One peculiarity of this convention is that if the coupon is 12-month LIBOR flat, and if this 12-month LIBOR resets as before at 6% exactly, the actual coupon in dollars you would receive at the end of the interest payment date of 12 months would be, assuming the year is not a leap year, this amount here, 100 times 6% times 365 over 360. And of course, if it is a leap year, this amount here, with the 366 replacing the 365 in the numerator of the fraction, either of which final calculations, of course, gives a slightly greater amount than the flat $6 that you might understandably have expected the answer to be. We should note that a number of important money markets outside the United States use the actual 365 day count convention, which works exactly as above, except for the insertion of 365 in the denominator instead of 360. The sterling money markets are one important example of this. We hope this discussion has illustrated sufficiently how careful you need to be in making sure you know the exact day count convention for any given financial instrument and how it works under different fact patterns. We refer you to a very comprehensive discussion of all the principal day count conventions that exist in the financial markets if you wish to learn more about this topic, found in this link to Wikipedia. We conclude this chapter 1 by introducing the terms clean price and dirty price. Assume a bond is trading at par, i.e. its price is 100, right after a coupon payment has occurred. Assume sometime later, when interest rates have not changed and the bond's perceived credit risk is still the same, Party A wishes to sell this bond to Party B when the accrued interest is now $1.75. Quite simply, the clean price would be quoted still as 100, while the dirty price, which is in fact the amount Party B pays to Party A, would be 101.75. The normal convention is to quote the clean price for a bond, it being understood that the accrued interest is added to the clean price to determine the total amount paid by the buyer to the seller. This convention applies even if the bond is no longer trading at par. Thus, suppose that as a result of a downgrade of the bond, it would trade today at, for example, 96 if there were no accrued coupon. Given the accrual of $1.75 in interest, the clean price, and therefore the price typically quoted over the telephone, would still be 96, whereas the dirty price of 97.75 would be the amount paid by Party B to Party A. This brings us to the end of Chapter 1.